Imagine a retail giant, a colossus that once defined American commerce, offering everything from homes to Hoovers through an unparalleled distribution network. Its stores were community anchors, its catalog a national institution. For decades, it was not merely a market leader, but a market shaper. Yet, even the mightiest empires can fall, not with a sudden cataclysm, but through a slow, almost imperceptible erosion of strategic purpose. This is the retail colossus's fall, Sears' slow decline. For over a century, Sears, Roebuck and Company stood as an undisputed titan of American retail. From its humble origins as a watch company, it evolved into a monolithic store of everything, embedding itself deeply into the fabric of American life. At its peak, Sears was more than just a retailer. It was a strategic marvel, a master of logistics and consumer understanding. It represented stability, reliability, and unparalleled reach. But as the retail landscape began its seismic shifts, this very stability would, paradoxically, become its greatest vulnerability. Sears's historic dominance was built on audacious innovation. In the late 19th and early 20th centuries, its catalog wasn't just a shopping guide. It was a revolutionary distribution model that brought goods directly to rural American households, bypassing local merchants entirely. This strategic move unlocked vast untapped markets. Products ranging from farming equipment and tools to clothing and even entire prefabricated homes were delivered with unmatched efficiency. Its strategic placement in burgeoning suburban landscapes with sprawling department stores, coupled with an aggressive diversification into brands like Kenmore and Craftsman, cemented its position. Data from the mid-20th century would show Sears commanding an overwhelming percentage of American retail spending, a true testament to its operational prowess and strategic foresight in understanding consumer needs and delivering them at scale. The seeds of Sears's decline were sown not by external aggression, but by an insidious strategic drift. As the market evolved, Sears failed to adapt. The mid to late 20th century saw the rise of agile discount retailers like Walmart, which strategically undercut Sears on price and efficiency, appealing to a cost-conscious consumer base Sears had once dominated. Simultaneously, consumer habits were shifting. The convenience of catalog shopping was superseded by the desire for immediate gratification and competitive pricing. But the most significant strategic miscalculation was its response, or lack thereof, to the e-commerce boom. Sears consistently underestimated the existential threat posed by online retail, while others invested heavily in digital infrastructure and seamless online experiences. Sears's internal strategic decisions often prioritized short-term gains, such as selling off valuable brands or real estate, over the necessary long-term transformation. Critical market data, screaming warnings about internet adoption and changing purchasing patterns, appeared to be ignored or misinterpreted. The company's vast physical footprint, once an asset, became a liability, hindering the flexibility needed to pivot. Instead of reinventing, Sears often resorted to minor tweaks, fundamentally misunderstanding the strategic imperative to rebuild its core business for a new era. Sears had numerous junctures to strategically pivot, yet consistently missed opportunities. The merger with Kmart in 2005, intended as a strategic consolidation, instead paired two struggling entities, creating a larger, more unwieldy organization rather than a revitalized one. Instead of investing heavily in modernizing its supply chain, enhancing its online presence, or developing innovative customer experiences, leadership often opted for asset stripping and financial engineering. The opportunity to leverage its vast real estate portfolio proactively, for example, or to truly integrate its beloved private labels into a modern retail ecosystem, were largely squandered. Each indecisive move, each delayed investment gave competitors a wider berth, slowly chipping away at Sears's once unassailable market position. The impact of these choices was clear: a continuous erosion of brand loyalty, declining sales, and a growing disconnect with the contemporary consumer. The prolonged struggle was a difficult watch for market observers. After years of store closures, management changes, and desperate attempts to revitalize the brand, the inevitable arrived. In October 2018, after 125 years, Sears, Roebuck and Company filed for Chapter 11 bankruptcy protection. It was a stark and sobering consequence of strategic inertia, a failure to read the market, and an inability to execute necessary transformations. The Colossus had fallen, not in a spectacular crash, but through a slow, drawn-out decline, a testament to the unforgiving nature of a dynamic market. The downfall of Sears offers a crucial lesson for any enterprise, regardless of its legacy or market dominance. In a world of relentless change, even the most established giants must commit to constant strategic evolution and adaptation. Market leadership is not a permanent title, but a continuous challenge, demanding vigilance, foresight, and a willingness to dismantle and rebuild even core business models. For strategy, much like a game of chess, is not about the strength of your starting position, but the wisdom and agility of your next move. Join us next time on the Boardroom Gambit as we scrutinize the WeWork house of cards, valuation versus reality, and explore the perils of market hype disconnected from fundamental business strategy. If you found this analysis insightful, be sure to like this video, share it with your colleagues, and subscribe to the Boardroom Gambit for more deep dives into the strategic plays that shape our world.